Last Sunday night, while most Americans were asleep, something happened in Tokyo's bond market that has not occurred in over 30 years. Japan's 40-year government bond yield crossed 4%, 4.24% to be precise. And on March 30th, 2026, 2 days ago, it happened again. The 40-year yield climbed back to 4.02%. The 30-year hit 3.79%, both approaching the records set in January. That is not a headline most people read. That is not a number most people track. But it is the number that determines how much it costs America to borrow money. And right now, that number is telling a story that almost nobody in mainstream financial media is willing to say out loud. The 30-year US Treasury yield closed at 4.98% on March 27th. 2 days later, it printed 4.905. It has been grinding against the 5% ceiling for weeks. And the question nobody is asking is the only question that matters. What happens when the country holding $1.225 trillion of your debt decides the math works better at home? Before we go any further, everything you are about to hear is built on publicly available, verifiable data. US Treasury Department filings, Federal Reserve publications, Bank of Japan policy records, Bloomberg and CNBC reporting. This is not speculation. This is pattern recognition applied to numbers that anyone can check. This video will walk you through 3 things. First, the mechanical reason why Japan and China are both reducing their appetite for American debt, not for political reasons, but for mathematical ones. Second, the $130 billion forced selling scenario that Citigroup published in January and that nobody on YouTube discussed. And third, the one number you need to watch every Sunday night for the next 12 months that will tell you whether this is a slow grind or a sudden break. If this kind of evidence-based analysis is useful to you, the subscribe button is right there. No hype, no price predictions, just the data. To understand what is unfolding right now, you need to see 2 forces that are colliding in the same market at the same time. On one side, the United States government has $38.86 trillion in gross national debt as of March 4th, 2026. That number is growing at $7.23 billion per day, according to the Joint Economic Committee's own monthly update. The Congressional Budget Office projects a $1.9 trillion deficit for fiscal year 2026. Debt held by the public has reached 101% of GDP and is projected to hit 120% by 2036. Every single month, the Treasury Department must auction hundreds of billions in new securities just to roll over maturing debt and fund the deficit. Those auctions need buyers. On the other side, the 2 largest foreign holders of that debt, Japan and China, are simultaneously developing structural reasons to hold less of it, not because of tweets. Not because of tariffs, although those matter. Because the domestic math in Tokyo and Beijing has fundamentally changed. Think of it this way. For 3 decades, Japanese insurance companies and pension funds looked at their domestic bonds yielding a fraction of a percent and looked at American treasuries yielding 3 or 4 times that. The decision was obvious. You park your money in American debt. But what happens when Japanese 40-year bonds start yielding 4%? What happens when the Bank of Japan raises rates to 0.75% and domestic yields become competitive for the first time in a generation? The decision stops being obvious. And when trillion-dollar portfolios start reconsidering obvious decisions, the consequences move through every interest rate on the planet. Let me walk you through the numbers, because the numbers are where the story lives. Japan holds $1.225 trillion in U.S. Treasury securities as of January 2026, according to U.S. Treasury Department data. That is the largest foreign position of any country on Earth. Now, Japan's finance ministry recorded that Japanese investors sold approximately $17.5 billion in long-term foreign bonds in a single week ending April 4th, 2025, with another $3.6 billion the following week. That was reported by the Financial Times. The selling accelerated from there. In December 2025, Japanese life insurers sold a record 822.4 billion yen, roughly $5.2 billion, in bonds with original maturities over 10 years. A single month. A record amount. That data comes from Japan's Securities Dealers Association, reported by Bloomberg. Now here's why they are selling. Companies like Daiichi Life and Nippon Life were sitting on estimated unrealized losses of approximately $60 billion on their domestic bond portfolios by early 2026. When domestic yields surge, the value of your existing bond holdings collapses. When your bond portfolio shows $60 billion in red, your risk models start screaming. You need to raise capital. And the most liquid thing these insurers hold abroad is American Treasuries. So they sell. This is not a political decision. This is a balance sheet decision. And it is happening at the same time that the Bank of Japan is tightening policy for the first time in decades. The BOJ raised its short-term policy rate to 0.75% in December 2025. The 10-year Japanese government bond yield hit 2.38% in January 2026, the highest since 1999. Let that number sit for a moment. The highest since 1999. Now turn to China. According to CSE data and US Treasury filings, China's Treasury holdings stood at $694.4 billion in January 2026. That is down from a peak of $1.317 trillion in November 2013, a reduction of roughly 47% over a decade. And in February 2026, Bloomberg reported that Chinese regulators explicitly advised financial institutions to limit purchases of U.S. government bonds and instructed those with high exposure to reduce their positions. Mohamed El-Erian flagged this shift in February. China's share of the total U.S. Treasury market has dropped to just 7%, down from 28% at its peak 15 years ago. That is not a rounding error. That is a structural repositioning. Now, I need to address something important here, because the headline narrative and the actual data tell slightly different stories. A detailed analysis published by Real Investment Advice in February 2026 pointed out that the U.S. Treasury's own holdings tables are built on custodial data, meaning they track where bonds are held for settlement, not who actually owns them. When China's official holdings fall by $600 billion and Belgium's mysteriously rise by $500 billion over the same period, what you are seeing is not necessarily a fire sale. Some of that decline reflects bonds moving through custodial centers like Euroclear in Brussels. That nuance matters. The raw headline that China is dumping treasuries overstates the pace. But even the adjusted numbers show a sustained, decade-long reduction in direct exposure. The direction is not in question, only the speed. Now here is the piece that almost nobody covered when it was published. In January 2026, Citigroup's head of Asia trading strategy, Mohamed Appleby, published a note to clients. Bloomberg reported on it January 21st. The note said this: if volatility in Japan's government bond market continues to spike, risk parity funds, the massive algorithmic portfolios that allocate capital across stocks, bonds, and commodities based on equal volatility weighting, may need to sell as much as 1/3 of their current exposure. The estimated impact? Up to $130 billion in bond selling in the U.S. alone. $130 billion from a single category of fund, triggered not by a policy decision or a geopolitical event, but by a volatility reading in Tokyo's bond market crossing a threshold in a risk model. This is the mechanical transmission that connects a Japanese bond sell-off to your mortgage rate, your car loan, your company's borrowing costs. It does not travel through headlines. It travels through algorithms, and those algorithms do not wait for permission. 2 days ago, on March 30th, Bloomberg reported that Japan's super-long bond yields were rising again. The 40-year back above 4%, the 30-year at 3.79, this time driven by the Iran conflict pushing oil prices higher and stoking inflation fears. The same pattern that produced the January shock is reasserting itself in the spring. The catalysts change. The mechanism does not. If you want to understand what happens when a major foreign buyer of American debt develops a structural reason to buy less, September 2022 gives you the clearest modern precedent. When the UK government announced approximately £45 billion in unfunded tax cuts, the gilt market did not just decline. It detonated. British pension funds had built enormous leverage positions in long-dated government bonds. When prices fell, margin calls cascaded. To meet those margin calls, funds sold more gilts. Prices fell further. More margin calls. The Bank of England was forced to intervene with emergency purchases totaling approximately £65 billion. The yield on 30-year British government bonds rose by roughly 100 basis points in a matter of days. The pound fell to its lowest level against the dollar since decimalization in 1971. The connection to Japan is precise. Multiple analysts, including researchers at J.P. Morgan, noted in April 2025 that Japanese life insurance companies occupy a structurally similar position: vast holdings of long-dated bonds, rising domestic yields, and capital reallocation requirements that are mechanical, not discretionary. The UK crisis lasted days. The Japanese rebalancing will take years. But the direction of the pressure is the same. So here is what the timeline looks like going forward, and I want to be precise about what to watch. Every Sunday night, when Asian markets open, the first signal comes through Japanese government bond futures. If 40-year yields push back above 4% sustainably, not a one-day spike, but a sustained move, the repatriation math accelerates. The 30-year US Treasury yield has been grinding near 5%. On March 27th, it printed 4.98. On the 30th, it dipped to 4.905 as Iran conflict fears pushed money into shorter duration safety trades. But here is the critical point. The long end of the U.S. yield curve is not falling when it should be. In a traditional flight to safety, war fears, equity sell-offs, long-term Treasury yields should drop as investors buy bonds. Instead, the 30-year is holding near 5% while equities fall and the dollar strengthens. That pattern, where stocks, bonds, and the dollar all move against the traditional safe haven playbook, is what J.P. Morgan's Michael Symbolist identified as occurring for only the 13th time since 1970. The last time all three American asset classes deteriorated simultaneously was 1981, 13 times in 55 years. We are in one of them right now. The next data points to track: the Bank of Japan's next policy meeting, where any further rate increase directly widens the domestic yield advantage and accelerates repatriation. Treasury auction results, specifically bid-to-cover ratios on 20-year and 30-year maturities, and the proportion going to indirect bidders, which is the proxy for foreign demand. As of February 2026, the 30-year bid-to-cover was 2.75, still healthy. If that drops below 2.3 in coming months, the market is telling you something has changed in the buyer base. And the TIC data, the Treasury International Capital Flow Report, published monthly by the Treasury Department, which shows exactly how much Japan and China bought or sold. The January 2026 data showed Japan increasing holdings by $39.8 billion from December. That sounds bullish until you understand the context. Japan's finance minister has publicly stated that selling U.S. bonds is on the table as a tool to stabilize the yen. They are prepositioning liquidity, not expressing confidence. So what does this mean for you? Let me be direct. If you hold long-duration bonds, 20-year, 30-year treasuries, or bond funds concentrated in that maturity range, the data suggests duration risk deserves serious attention over the next 12 months. The structural forces pushing long-end yields higher are not temporary. They are demographic in Japan, strategic in China, and fiscal in the United States. That combination does not resolve in a quarter. If you hold gold, the framework is worth understanding. Gold hit $5,634 in late January before correcting to current levels around $4,600. Wells Fargo raised its year-end target to $6,100 to $6,300. J.P. Morgan sits at $6,300. The People's Bank of China has been buying gold for 15 consecutive months. Central banks globally purchased over 1,000 metric tons in each of the last 3 years. When the institutions that manage sovereign reserves are reducing treasury exposure and increasing gold exposure simultaneously, that is not a trade. That is a regime change in reserve management. If you are trying to understand mortgage rates and borrowing costs more broadly, the 30-year Treasury yield is the benchmark that prices everything from home loans to corporate debt. If 5% becomes the floor instead of the ceiling, as the structural evidence suggests, the interest rate environment of 2021 is not coming back. Build your financial plans accordingly. This is not financial advice. This is pattern recognition applied to publicly verifiable data. Make your own decisions. Let me leave you with this. For 30 years, the system operated on a simple assumption. Japan and China would keep recycling their surpluses back into American debt because there was nowhere else to go. That assumption funded deficits, suppressed yields, and kept mortgage rates affordable. Japan's 40-year bond now yields 4% for the first time in 3 decades. China's share of the Treasury market has fallen from 28% to 7%. The US national debt has crossed $39 trillion, growing at $7.23 billion per day. And the 30-year Treasury yield is pressing against 5%, while every traditional safe haven signal says it should be falling. The anchor is moving. The question is whether you notice the drift before the ship has already changed position. If you want me to go deeper on the specific transmission mechanism from Japanese insurance portfolios to American mortgage rates, tell me in the comments. And if this kind of data-first analysis is worth your time, subscribe. Not for me. For the next Sunday night, when Tokyo opens and the numbers start moving. I will see you in the next one.